Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. This week, we're doing something unique with the podcast, and then I'm offering a series of interview previews for interviews that will take place in the DIY Investing Summit next week, which begins Monday, January 23rd. And the summit is being put on in partnership between Seeking Alpha and Investor in the Family, and each one of these interview previews stands alone in its value, but it gives you a glimpse of what the rest of the interview may be like, as well as the rest of the summit, which overall has 25 interviews from some of the top investors from Seeking Alpha. Registration for the summit is free for a limited time, so be sure and check it out at DIYinvestingsummit.com. That's DIYinvestingsummit.com, or you can check out any of the links in the show notes or the article. And I hope you enjoy this interview excerpt with Avi Gilburt. You know, if you had to give a State of the Market speech to U.S. investors going into 2017, and what your main points would be, is that something that you feel like you could answer, or is that something that really just doesn't fit your strategy at all?
Well, I think we can answer it, but we always answer it with a perspective towards risk management. For example, one of our perspectives coming into 2016 was that we saw the market heading up to a target of 2,300 for the year, but we also said if the market breaks below, let's say 1,750 on a correction we expected going in February, then it potentially could invalidate that perspective. And I'm looking at the SPX right now, and the SPX right now, as long as we hold over 2205, I'm looking at 2017 taking us over 2,500 on the SPX.
Wow. This kind of blends well with the next question too, as far as positioning yourself for the start of 2017, things that you're excited about. So assuming current trends with the S&P continue, you're looking for 2,500 in 2017 on the S&P.
I'm looking for a minimum of 2,500. My target for several years now has been 2,537 to 2,611. There are clearly extensions that could take us up to as high as 2,700 and change. But once we get into that 2,537 to 2,611 sweet spot, at that point is where we're going to start unloading our long positions, and for the aggressive people to start even looking to set up some long-term shorts.
And so you're looking for that, and what did you say would probably help invalidate that upward trend?
If the market broke down below 2205, I would have to question that perspective. So over 2205, I am strongly bullish. And even right now, as we're speaking today, as long as the market stays over 2245, we could be on our way directly over 2300 pretty soon.
Wow. How about when it comes to metals like gold and silver?
Well, right now we are in the confirmation process for the next major move. About a little over a week ago, about 2 weeks ago actually, I put out an update to our members that based upon the structure going down in the miners, based upon the technicals we were seeing, I said, this is normally a setup for an immediate 10% plus move to the upside. And, the sentiment was very, very bearish. And, I had even some disbelievers among my own members. But the market followed through up quite strongly. And right now, as long as we don't break back down below let's say the 1950 to 2050 region, we could be on our way to retesting the August highs within the next month or two. And if we do that and pull back correctively, well, I'm looking for 60 to 70 on the GDX once we break out over the August highs. So I'm still looking for confirmation, and we're still watching this very closely to make sure the structure continues as it's presenting. But assuming it does continue as presenting, once we break over the August highs, we're looking for 60 to 70. It could take a year to 18 months to get there.
I'd say that's worth waiting for.
Yeah.
And so when you mentioned as long as we stay above 1950, you mean in the GDX, then you expect we could retest the August highs in the GDX the next month or two. And ultimately, if staying above that level you're looking to see 60 to 70 on the GDX in the next year or 18 months. So obviously, very bullish.
Year 18 months after we break out over the August highs, because once we get towards 28 to 31 region, I expect maybe a month or two of consolidation. And then when we break out over the August highs, that's when I'm expecting 60 to 70 on the GDX within 12 to 18 months.
Wow. Are you likewise positive on, so you're obviously bullish on equities, bullish on metals. Do you still feel positive regarding emerging markets and bearish on bonds?
We are still positive on emerging markets, and for now we are still bearish on bonds. Clearly, there could be corrective rallies that we could see, but we're definitely for now we're still pretty bearish on bonds. But right now, as long as, for example, I'm looking at the EEM right now, as long as the EEM remains over the 3270, the 3275 region, then we're looking for we're going to test the 40s pretty soon. I think we're still pretty much bullish most all assets.
Excellent. That's great and very that's helpful, because I think a lot of people, especially with the rally post election, and a lot of people you speak to are thinking, well, surely this won't end and it's going to fall back and so on and so forth, which is not uncommon to a lot of things we've heard for years. And it's, it's kind of refreshing to hear your perspective, and that you're actually expecting things to continue to get better based upon your Elliott wave analysis.
Well, I will tell you this, and you can ask anybody on my site. My perspective going into the election was I really didn't care who won. The market was going to do exactly what the market was going to do, no matter who won. And I think what the market did, and the reason it surprised so many people, was because it did what it was going to do, even though Trump won. And that was a perfect example. Everybody expected the market was simply going to crash if Trump won. And what did the market do? Market just shot up higher. And, I think that's the best indication to show that sentiment for the market, not necessarily the news, sentiment for the market is what really directs where the market is going.
I hope you enjoyed this excerpt from the DIY Investing Summit. If you want to hear the rest of the interview and the other 24 interviews from the summit, be sure and visit DIYinvestingsummit.com. That's DIYinvestingsummit.com, or you can click any of the links in the article or show notes to this episode, and it'll take you straight to the registration page. And remember, the summit begins Monday, January 23rd. You can still register after that, but you'll miss some of the content. So register by Monday, January 23rd at DIYinvestingsummit.com, and I'll see you there. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.